I'm going to tell you how to optimize your tax advantage and taxable investment accounts, and we're starting right now. 401ks, IRAs, HSAs, 403bs, 457s, TSPs, taxable, traditional versus Roth, backdoors, mega backdoors. There are so many investment accounts, it can make your head spin. Ow, that was a little too hard. The fact is, we can simplify these accounts into a single idea. The government wants to encourage you to save for retirement so that when you're too old to work for income, you don't require too many tax dollars to support you. The best way to grow any money saved is by investing it. And the best way the government has to keep your savings growing as fast as possible is by not taxing it along the way. Regardless of the tax advantage account, the government will tax your income. At the most basic level, minus a few loopholes which we'll explain, every one of the available tax advantage accounts will tax your income with a 10 to 37% income tax. What the government offers is a means to forgive taxing the earnings your income makes after being saved and invested. You see, while your income will be charged income tax of 10 to 37%, your investments, when they earn you money, are also taxed. The earnings on savings accounts and bonds is called interest, and the earnings on investments is called dividends. Both are subject to the same 10 to 37% marginal tax rate as your income. But to encourage investors to support the growth of companies through investments, a riskier but in the long term more beneficial contribution to the economy, the government taxes investment growth at a lower rate than income. The government taxes investment growth once you sell your investment shares, also known as realizing the gain. When you sell a share, the government will tax the difference between the amount you sold it for and the amount you bought it for. This is called a capital gain, and it's subject to a lower 0 to 20% capital gains tax depending on your tax bracket. Furthermore, most US stock dividends and some international stock dividends for countries we have tax treaties with also fall under these lower 0 to 20% capital gains tax rates. These are called qualified dividends. Tax advantage accounts will not avoid income tax, but do avoid all interest, dividends, and capital gains taxes. That's basically what you need to know about how all tax advantage accounts save you from taxes. That's 401ks, IRAs, HSAs, 403bs, 457s, TSPs, all of them save you from interest, dividends, and capital gains taxes, but not income tax. Now, different flavors of them change when you're charged the income tax. Traditional retirement accounts save you from being charged any income tax going into the account and wait until you take the amount out of the account before charging you income tax. While Roth retirement accounts charge you income tax going into the account, but then aren't charged income tax coming out of the account. If your tax rate is the same when the money goes into the account as when it comes out of the account, the traditional and Roth accounts give you exactly the same amount of money. People confuse this all the time. They think, I'd rather my tax be applied now while the amount I put into the account is small than be taxed later when that balance has grown. But let's look at an example. Now let's imagine I have $1,000 of income that I'm taxed at the 22% tax bracket with a 7% rate of return over the course of 5 years, and I want to compare how contributing to the traditional IRA will compare against contributing to a Roth IRA. For the traditional IRA, I take my $1,000 of income and put it there. For the Roth IRA, I can't put in the full $1,000 because I'll be taxed on my $1,000 of income. So I want to actually type in 1,000 times 1 minus my tax bracket. So I'll actually be contributing $780 after taxes. Now, let's include our rate of return. So we will take our original number, multiply it by 1.07 for our 7% return, and we'll continue doing that year after year compounded for an ending total of $1,403. Now let's do the same for a Roth IRA. We'll take the original amount, compound it by 1.07 year after year, and we end up getting a lower result after 5 years. The problem is, though, for the traditional IRA, we are then taxed when we take the money back out. So instead of getting the full 1403, we actually need to multiply by 1 minus our tax bracket here. When we do that, we end up getting exactly the same amount between the traditional IRA and the Roth IRA. If your tax bracket is the same going into an account as it is coming out of the account, the traditional IRA and the Roth IRA will end up in exactly the same return. So for retirement accounts to save you more than taxes on investment earnings, and also save you some on income taxes, You need to predict if your tax bracket in retirement will be higher or lower than it is today. There's no way to know for sure, but given there's a big jump in the income tax bracket from 12 to 22% for single filers making more than about $40,000 a year and married filers making more than about $80,000 per year after considering tax deductions, it makes sense for filers making under that amount to pay taxes now with Roth retirement accounts, and for filers making over that amount to consider paying taxes later with traditional retirement accounts. Early retirees do particularly well with traditional retirement accounts because they typically have high incomes in their earning years and low expenses, and therefore low retirement withdrawals, in their retirement years. So they avoid paying high taxes early on in favor of paying low taxes later. However, IRAs have some income restrictions to know about. While anyone with earned income, which is non-passive income that you worked for, can contribute that income to a traditional IRA, the amount of your contribution that qualifies to not be taxed starts phasing out if you make above $65,000 as a single filer or $104,000 if married. But that's okay, the government will never require any of your income to be taxed twice. If you make too much to take the tax deduction, but you still contribute to a traditional IRA, the dollars that aren't taxed become what is known as your basis. It's like a special bucket of dollars in your traditional IRA that will never be taxed again, even if you withdraw it. So it's kinda like a Roth IRA within your traditional IRA. But with one big difference. The earnings on those dollars, just like the earnings of all dollars in your traditional IRA, do not become part of your basis and will be taxed once withdrawn. Because of this, people with a non-zero basis in their traditional IRAs tend to roll these funds over to a Roth IRA where, again, it won't be taxed when withdrawn, and furthermore, like all funds in a Roth IRA, the earnings aren't taxed. There is one thing to be careful about when doing this. If you have some money in the non-basis bucket and try to roll over some basis funds from your traditional IRA into your Roth IRA, the IRS says you must do this proportionally to the funds in your traditional IRA per the pro rata rule. So you can't just move the basis dollars to the Roth IRA. If you have, say, half of your traditional IRA as basis and half outside of basis, then half of whatever you roll over will be taxed. That's all there is for traditional IRAs. For Roth IRAs, there's an income limit after which the amount you can contribute is phased out. If your income is above $140,000 for single filers or $208,000 for married filers, you are no longer allowed to contribute to Roth IRAs. If you expect to be close to that amount, don't sweat it. The IRS lets you recharacterize your contribution after the year and before filing your tax return the following year. While Roth IRAs are off the table for high-income earners, we didn't say traditional IRAs were. There is no income limit for traditional IRA contributions, only how much can be deducted from taxes. High-income earners can make non-deductible contributions to a traditional IRA under the basis bucket, then roll these funds over to a Roth IRA so all their investment earnings are never taxed again. This is known as the Backdoor Roth IRA. All income earners can do something similar with rolling funds over from their traditional 401ks to their Roth IRAs. The IRS states that you and your employer can actually combined contribute up to $58,000 between your employer-sponsored retirement plans like a 401k or a 403b. While only $19,500 of that can go towards being deducted from taxes, the remaining amount can be added into the basis bucket under what are called non-Roth after-tax contributions. Since these contributions nor the earnings in the 401k are subject to favorable tax treatment, you may wonder why anyone would want to do this. Well, like the Backdoor Roth IRA, you can roll over your basis from your 401k into your Roth IRA, where the investment earnings will never be taxed. You've effectively just done a Backdoor Roth IRA for up to $38,500 per year, which is why they call it a Mega Backdoor Roth IRA. This also isn't subject to the pro rata rule, which only applied when you roll over from an IRA. The one issue you may run up against is the fact that 401ks are employer-sponsored, so whether or not you can even do a Mega Backdoor Roth IRA is entirely dependent on your employer supporting these non-Roth after-tax contributions to your plan, and also on them allowing in-service, meaning while employed, rollovers of your basis to a Roth IRA. Like the traditional IRA, any earnings your 401k basis earns still goes into the non-basis bucket and will be taxed upon rollover to a Roth IRA. Therefore, when you roll over your basis to a Roth IRA, you can also roll over the earnings to a traditional IRA. Rolling over from one traditional account to another traditional account doesn't trigger a taxable event. When you finally withdraw the funds from your traditional IRA or roll them over to a Roth IRA, they will be taxed, but you can control doing this in lower income years, such as in retirement. And the earnings shouldn't be very large to begin with because you rolled them over in service shortly after contributing the funds. Last on the review of different accounts, I want to talk about HSAs or health savings accounts. HSAs are designed to help you cover health expenses. You can only make contributions to an HSA if you are covered under a high deductible health plan, meaning plans where you pay a bit more for medical expenses, but typically in exchange pay less for monthly insurance premiums. If you have a high deductible health plan, you can contribute up to $3,600 per year for an individual or $7,200 per year for a family. These plans are like traditional IRAs in that they aren't taxed going into the account, but furthermore better than traditional IRAs, when you take money out of the account for medical expenses, they come out of the account tax-free as well. You don't even need to take the money out of the account in the same year as the medical expenses. There's no expiration date. You can collect medical receipts over years, never withdraw from your HSA, and let the account grow unimpeded by interest, dividends, or capital gains taxes. Then late in retirement, withdraw the receipt total from your HSA completely tax-free and use it to buy, a house. The only caveat is if you withdraw the money from your HSA for non-medical purposes prior to age 65, you'll owe the IRS a 20% penalty. With all these options, you may be asking how to prioritize your contributions to maximize tax efficiency. Well, here's your answer. First, you should always contribute enough to your 401k or Roth 401k to maximize your employer's match. It's free money with a higher return than any investment can offer. Second, you should max out your HSA if you're on a high deductible health plan, as it's the only account that has the potential to completely avoid income tax and at worst acts like a traditional IRA. The rest depends on if you favor traditional accounts or Roth accounts. For traditional accounts, next would be maxing out your traditional IRA because it usually has a better selection of funds to invest in than your 401k. Then your traditional 401k, then your mega backdoor Roth IRA, then your taxable account. For Roth accounts, it would be maxing out your Roth IRA, or for high income earners, your backdoor Roth IRA. Then your Roth 401k. Then your mega backdoor Roth IRA after your Roth 401k, just because of the small amount of earnings going into the non-basis bucket to be taxed later. Then your taxable account. For those uncertain about their tax future and who are therefore indifferent about traditional versus Roth, which I think should be most people, here's what I recommend. After 401k match and HSA, next, max out your Roth IRA. This is because your Roth IRA is liquid, allowing you to withdraw contributions at any time for any reason penalty-free. Then your traditional 401k over your Roth 401k because you have more control over when you'll be taxed in the future. Then your mega backdoor Roth IRA, and then your taxable account. If you do invest in both tax advantage and taxable investment accounts, it'll help to put your most tax inefficient assets into the tax advantage accounts, leaving your most tax efficient assets into the taxable account. Your tax inefficient assets are the ones that generate interest because it's taxed at the higher income tax rate, and also your most actively traded funds because their holdings might not be held for at least a year and therefore don't qualify for the lower capital gains tax rates. For this reason, I always keep my real estate or REIT assets and bond funds in a tax advantage account because they generate ordinary dividends and interest. That's all for today. Love you guys. See you next time. Be sure to smash that like button, subscribe to see my next video, and comment down below about what you think, and I'll be sure to respond.